Hello, everybody. Kirk Spano, Investing 2020s. And today we are going to talk about entertainment, streaming, all things that you find with Disney and Hulu and Comcast, Max, Peacock, Walmart, just a whole bunch of different companies trying to get your viewership for a fee. And I think the best place to start is with the writers' strike that's going on right now and the ramifications across the industry. I mentioned to you probably a year and a half, 2 years ago, that I thought there was too much content, really just too much spending on content, and that the companies wouldn't be able to keep that up. Well, we've seen that become true. We've seen the companies commit to rationalizing their balance sheets, to measuring the amount of content they put out and how they put it out. The direct-to-streaming model has really only survived at Netflix. Everybody else is moving back to theatrical releases. And now we have a strike because there is a war going on that pits AI and studios and writers in a very precarious position. I think the studios realize that the writers are essential, but that AI can be a great tool. I think in some darker corners of entertainment, they look at AI as a potential replacement for writers, but I think that that would probably backfire. Ultimately, like all things AI that I've been talking about for the last several months at least, AI just becomes a tool that the writers use to condense the amount of time it takes to produce the content they're trying to put out there. It's very similar to what's happening in medicine, in my industry, finance, and almost every industry out there that uses AI. It is a way to become more efficient. It is not necessarily a way to replace jobs. It just might reduce the number of hours you have to work if you're trying to find some sort of work-life balance. The issue that we're seeing in this strike not only has to do with AI, but also how the writers get compensated for the shifting business model in entertainment, away from linear TV and towards streaming. And what's weird about that is when you take a look at a company like Hulu, to a lesser extent Sling, and you basically find cable packages that stream. That's really what Hulu Live is. It's basically a cable package that you stream on your Wi-Fi rather than having it come in through a cable box or into your television that acts as your descrambler. What I think we are finding out is that more content got to become too much content, and that during COVID, when everybody caught up on every TV show that they've ever meant to watch, and even those that you didn't mean to watch, and then you did it anyway, there was a peak in content demand that has come down pretty significantly, I think, in the last year or two. Demographics play a part of that, just like it does in any other industry. And as this strike plays out, and it looks like they're on the verge of a deal suddenly, right around Labor Day, which is what I mentioned about a month ago, they will probably come up with a deal that puts an ultimate cap on the amount of money that goes into content, probably preserves all of these jobs, but slightly changes their nature. And you're probably going to see more pay to the bottom and middle tiers and a little bit of compression at the top. Right now, it's about a dozen Hollywood stars. If you take a look over at the actors side, they make something like half of the money. And everybody else in the industry on the actor side gets the rest. For the writers, it's a little bit similar. Your top writers are still making a lot of money, your showrunners as well. And they really just are looking for a way to preserve that. Because if there's any ideas out there that they're going to get a raise in aggregate, they're wrong. But the bottom end and the middle have to find a way of staying involved and having a career. That money can really only come from the top. There's not going to be more money coming from the studios. To the extent that AI makes them more efficient, that would be how they make more money. And international distribution strategies are really the only place they can get growth. There's really no growth left in America for entertainment. I've talked about how I think that sports are in a bubble right now. So I have been piling into Warner Brothers Discovery and Paramount because they're down so much. And those libraries that they have are probably worth their current market caps. I don't think there's really much downside. The upside for Max and for Paramount are that they will probably be bought out at some point. And there's a series of events that are going to go down here in the next 2 or 3 quarters, with the linchpin being what happened with Hulu that drives 2 or 3 more transactions. And we will take a look at that. So the last Hollywood strike for the writers lasted about 100 days. That's about where they are now. One of the things that we talked about that was a linchpin for the Warner Brothers and Discovery deal was reality TV. It doesn't require much in the way of writing. It's a much cheaper type of TV to make. And that's how Warner Brothers Discovery, along with more theatrical releases and getting rid of shows with low viewership or high residuals, some combination thereof, cut $3.5 billion of debt so far, with another billion or two to go, and suddenly are on the verge of profitability, which should be guaranteed when this contract is cut. Paramount is in much the same position. Over there, they cut the dividend, the stock plunged, but suddenly they're on the verge of being cash rich with a valuable library, some core franchises, and the ability to put out Star Trek movies and everything else that they own. Disney is a little bit different animal in that it has the partnership with Comcast on Hulu. Hulu is a distribution platform. And the reason why I put Disney back on our plug and play list this week is because I think that they are going to make a couple of huge decisions by the end of the year. One of them will be Hulu. The other one will be ESPN, which plays into the Hulu strategy. Disney is going to choose between becoming a behemoth or just becoming extremely profitable and streamlined. Either way, I don't think they lose. They're trying to figure out which way they win the most. Right now, they have 3 basic ways of making money: the studios, the parks, and the streaming. Year over year, you can see that their linear networks lost about $500 million, but most of it went back to the direct-to-consumer side. So the net loss was small. Licensing stayed about the same. Ultimately, they had a small loss. When things are in transition, they get beat up. And consumers and investors get confused. They may stop spending money for a little while or investing in a stock for a little while. I think that both things have happened in streaming and with the entertainment companies. People don't understand what's going on, so they don't invest, and negative narratives get out there, and they may not even subscribe. As we go through an M&A process, which is going to start imminently, it's what I've been talking about for 2 years that was coming, you're going to see profitability at these companies come roaring back. You already can see the operating income is rising. So you take a look at Disney in particular, and you have to try to back out what their strategy is going to be. And it does all depend on Hulu. They have a deal with Comcast that in January, one of 3 things is going to occur. Either Disney buys Hulu from Comcast for between about $7 billion and $12 billion. They have that on their balance sheet. They can just write a check. Now, Comcast can cause some trouble. Comcast could insist that they try to value the company at a higher price based on what it would go for if they sold it. I'm not sure what Hulu is worth, but right now, the floor value per contract between the 2 companies, the share ownership, Disney at 2/3, Comcast at 1/3, it's $27.5 billion. There's an interesting thing that could happen. If Comcast pushes really hard to find out what the auction value is, and if that auction value is higher, Disney could just say, fine, let's sell it. In which case, Meta or Google or some other tech giant that wants to get into television, Amazon maybe, buys it. So with a valuation at $27.5 billion right here, and Hulu currently not contributing to the venture, which is diluting their ownership, they could ask for a valuation. And really the only way to get that is to try to auction it off. And I'm sure Disney would have the right to match. But let's ask what Hulu is. Hulu is basically Disney Plus on one side. Doesn't offer any real value to Disney to distribute Disney. But Hulu Live is just like your cable package, but you stream it instead. Does it benefit Disney to have that? Not entirely sure I know the answer, but if suddenly a big tech company wanted to buy it for 30 or 40 billion dollars, why wouldn't they sell it? And then just have a distribution channel for ESPN and ABC and Disney, license ABC to the remaining cable packages and to Hulu and to Sling, the way they've always done with the cable deals. It would bring their overhead down a ton, and they'd get an infusion of billions and billions of dollars without really impacting their ability to distribute their content. And then they would just have their direct to consumer brands, Disney and ESPN. And frankly, if they get rid of Hulu, I would think that maybe they just spin off ESPN. That could happen a couple of different ways. They could IPO 10 to 20% of the company to establish a valuation and bring in more money to the House of the Mouse. And they still have Disney. And then they'd still have ABC and everything that it has. What exactly is Disney? It's huge. Marvel, Fox Entertainment Group, studios, music, the parks. They're direct to consumer internationally. They've kept away from Hulu. They've done it themselves. ESPN. Do they need Hulu? Maybe not more than one of the big tech companies needs it. I think the Meta might shock you and make a huge bid for this. Now, if Disney keeps Hulu, yeah, they write a $10 billion check, give or take. And now they just have another distribution channel. It'll probably be mostly American. They use something called Star in Southeast Asia. Maybe they had Hulu somewhere else as well in their minds. But for people around the world that want American entertainment, there's no shortage of ways to get it with all the streaming apps that are out there now. Would people in Europe or Asia want the essential US cable package? Probably not. So that's really an American and I guess Canadian thing. I think there's a pretty good chance that you see Hulu get bought by somebody other than Disney and Comcast, who currently jointly own it. And if that happens, both of those companies do extremely well with the cash infusion. The only way that I don't think that is what ends up happening is if there's just not a bidder above $27.5 billion, which I can't really believe would be the case. So we'll see. Google doesn't really need it. They have their own thing. I think the only way that Google would buy it is if they got ESPN with it. And frankly, I don't know how ESPN fits in with Mickey Mouse, given that ESPN just did a $1.5 billion gambling deal with Penn. So to me, if I were Disney, I would sell Hulu, I would sell ESPN, and I would just pull in tens of billions of dollars today, and then go about your business distributing movies and Disney content, and then figure out what to do with ABC. There's power in owning a news network. There's no doubt about that. But they could shrink down what they offered via ABC and rationalize their expenses there too, with a focus on Disney content, which is what drives a lot of people to their parks. If suddenly they had tens of billions of dollars coming in one big hunk, without really much change to revenue, I don't think, maybe they could build another gigantic park somewhere that generated billions more in revenue. I don't think they're ever going to shut down Orlando. But why can't they make one of their parks somewhere else even bigger? Or drop a park into India. I don't believe they have one in India, which would become a linchpin for selling more Disney Plus. Disney is pretty much collapsed off its high, down over 50%. I think we're really close to the buy zone that I identified a while back, around $80. Remember, I was sad that I didn't buy it here when it sniffed under 100. But it always made sense to me that it would get under this level, and now it is. So you have a price under 90. I think it could go all the way down to around 80, but it's already down from 190. So I think we should be nibbling in here a little bit. We should be adding this to our basket of stocks in this industry that once the Hulu decision is decided, that's going to be the dominoes for more M&A. Let's look at it from the standpoint of Comcast. If Comcast suddenly gets a hunk of cash, they become a buyer for Warner Brothers Discovery. That's been the rumor, and I think it's a good rumor. CNN would probably get spun off from that because NBC, which is owned by Comcast, has a news network. They wouldn't need CNN. They could turn around and sell CNN to whoever, which is also a rumor. Two different groups apparently want it. And then we haven't even talked about the big tech companies that could use a news division. Paramount then becomes in play. The rumor there is that Apple would be interested, and it certainly makes a lot of sense given that Warner Brothers would be off the market if Comcast bought them. Apple would suddenly get a news division and more sports. I think the future of entertainment is largely in the hands of big tech. I think you do see one or two really big acquisitions. Apple doesn't need Hulu. Google doesn't need Hulu. Zuckerberg wants more reasons for you to be in their app. And there's this Elon Musk guy who's trying to put something together in media. He paid $43 billion for Twitter. Why wouldn't he pay another $40 billion for Hulu and put them all together? Something's coming. I don't know exactly what. I'd be shocked if there's not a tech bidder for Hulu. And I think it would be a mistake for Disney not to sell because they really don't need it. The only question becomes, do they sell ESPN as well? In my opinion, they should. I don't think everybody sees the bubble in that industry that I see, but I think they'd be essentially getting very near peak prices by selling ESPN now. There really doesn't seem to be a way for these companies at such low prices, Warner Brothers, Discovery, Paramount, Disney, in a world flush with tech money, to really not have pretty significant upside, doubles and triples in front of them. And from there, we'll see. Disney's talking about having a dividend again at the end of the year. Modest, they said. But if they have a modest dividend get announced at the end of the year, and then they suddenly have $30-40 billion come in the door, if they would decide to sell Hulu and ESPN, that dividend would go up pretty quick. So I think the rally that you're going to see in the next few years on Disney is back to all-time highs and then even higher if they make some strategic sales. If they decide to buy Hulu, try to wield it, manage it, and turn it into something bigger, I don't think that the growth that they get will be as good as people want for what they spend. I think Bob Iger is a pretty smart guy. The way that he's gone back and forth on what Hulu means to Disney makes me think that he's negotiating. So I'm going to speculate right now that Hulu gets sold and maybe ESPN too, and that suddenly Disney is sitting on a mountain of cash without really having negatively impacted their distribution of content or gotten rid of growth that they can't have anyway. As far as Warner Brothers goes, I'm having a hard time seeing them not get acquired by Comcast, actually, and Paramount getting acquired by Apple. I think the people involved all have major financial motivations to be acquired. And I think there are big piles of money out there looking to acquire. It would be unusual in those situations for M&A not to happen. And if interest rates come down just a little bit, by the end of the year into next year, then M&A really takes off again because there's a lot of pent up M&A out there that hasn't been available to get done because of the tightness in the financial sector and the banking sector. So we'll see. But I think that you should be building your basket of streaming stocks, Disney, Paramount, Warner Brothers, Discovery in particular, same way that you built out your space basket. You want the companies with high growth and the companies that can be acquired. I'm not sure if Netflix is a company I want to own when the combined forces of tech money and content libraries and studios consolidate. So I think it's going to be a much harder world for Netflix. I think they survive. I don't think it would be a bad idea for Netflix to acquire Paramount either. I think a lot depends on what the exit strategy is for the Paramount management. We'll see. There's no shortage of things that could happen. But these companies that have content and have assets that can be sold or can be completely acquired from these prices, these huge collapses in price that we've seen, don't have a lot of room to go anywhere but up. So I think that these are stocks, Paramount, Warner Brothers, Discovery, and Disney, that all have pretty significant margin of safety. I think Disney has the most execution risk at this point. They have to make good decisions, but if they do, stock is going to scream. You've seen it happen before. And I could see it. If they sell Hulu, I think you could see it just scream to the sky, like in a matter of months, just like it did here, under a year, get back to its all-time highs. So start nibbling in on that. I will put out a couple of cash secured puts that I like later today, and then we'll go from there. Any questions on this industry? I always figure that most of you have been following along for a while, so you knew a lot of this story already. No. All right. Well, then let's call it a day.